Hello, my name is Edmond Jamna, and on behalf of DW Consult, I want to welcome you to Tutorials on the Go. Our zeal here is to help transition people with zero, struggling, or shaky base in accounting to an expert position and to a place of confidence. It is also a platform to assist in the smooth studying of the ACCA and ICA professional qualifications, as well as for any tertiary accounting discipline. All that is required of you is to subscribe to our channel and click on the notification bell as well to be part of the program. Tutorials on the Go, bringing accounting to heart. Now, to this episode's lecture. Cost of investment. Now, this is the consideration, that is, the amount a parent pays to secure a controlling interest in a subsidiary. So there are four types a consideration may take. The first is a cash consideration. Second is a share exchange. Third, a deferred consideration. Then lastly, a contingent consideration. We'll first take a look at the cash consideration. So this is where a parent pays in cash an amount of money before or on the date of acquisition. So this has been the scenario in all our previous discussion. So they just state the amount that the parent paid in the question, the share exchange consideration. So here, a parent issues its shares to the subsidiary as payment for the controlling shares it is securing. So let's look at the steps in calculating cost of investment when there is a share exchange. The first is that you have to estimate the number of shares the parent has acquired in the subsidiary. You can do so by multiplying the percentage ownership by the number of total shares of the subsidiary. And secondly, you estimate the number of shares the parent has issued as payment for the subsidiary's shares. Thirdly, you now calculate the value of the parent's issued shares by multiplying it with the fair value or the market value. Then you now record the value in the equity section of the consolidated statement of financial position by adding it to that of the parent. So this will be broken down into share capital, which is the same as the ordinary shares. So you multiply the number of shares issued by the parent to the shares nominal value. So the nominal value is usually found by the ordinary shares in the statement of financial position. Okay. Then in addition to the share capital, there will be a share premium. So this is where you multiply the number of shares issued by the difference between the parent's fair value or the market value and the nominal value. And then you add it to that of the parent if there is a share premium already present. If there isn't, you create a column and post it there. Let's test our understanding. So Sherita acquired 90% of the 10 million ordinary shares of $1 of Olivia by a share exchange of 1 for every 5 shares acquired. So you see that there is a $1 quoted by the ordinary share, that is the nominal value. So the fair value of Sherita's shares is $3 per share. The nominal value is $1. So let's calculate the cost of investment for the acquisition and prepare the journal entry to record the share issue. By way of solution, the subsidiary's shares acquired by the parent is 9 million, which is the 90% stake of the parent by the 10 million shares of the subsidiary. Then the parent's shares issued is 1,800,000. The question said that for every 5 shares that the parent took from the subsidiary, it gives out 1. Okay, so if there are 9 million shares that the parent acquired, we have to find 1/5 of it. The ones we found, the number of shares that the parent issued, we have to find a value. So we multiply it by the fair value of the parent's share. So it will give a total of $5,400,000. So upon recognizing it in the consolidated statement of financial position, there will be a share capital of $1.8 million, which is the 1.8 million shares multiplied by the nominal value, which is 1 in the question. So when you come to the share premium, it will be 3.6 million, which is the 1.8 million shares times the $2, which is the premium. The fair value was $3. The nominal value was $1. So when you go to the financial position, if there is a premium in the parent individual account, you add this to it. If there isn't any share premium, you just record the 3.6 there as a new column. Let's move on to deferred consideration. So here, a parent pays cash in the future to the date of acquisition of the subsidiary. The deferred consideration must be discounted with a chosen rate to the present value at the date of acquisition and recorded. The consideration must be unwound to its final value, that is the amount agreed to be paid at the future date, by applying the original rates used in discounting the consideration. The adjustment of the unwinding will have no impact on the consideration already posted. Okay, so when the unwinding is done using the rates, we will debit the finance cost in the statement of profit and loss. then we credit deferred consideration liability. Let's test our understanding. Megiddo acquired 80% of the 20 million $1 equity shares of Daniel on 1st January 2015. The consideration was through a cash payment of $1 per share payable on 31st December 2015. So the acquisition was done on 1st January 2015. Payment will be made on 31st December 2015. That is 1 year after. The fair value of the Megiddo's equity shares was $2 at 1st January 2015. The present value of $1 received in a year's time is at a rate of 10%. So we have to calculate the cost of investment in Daniel at 1st January 2015 and the necessary entries as at 31st December 2015. So we come to the workings. The subsidiary shares acquired is 60 million, which is 80% of the total shares of the subsidiary, which is 20 million. Then the deferred consideration will be $14,560,000. So the 60 million shares that the parent has acquired from the subsidiary times the $1 that the parent is supposed to pay per share acquired, multiplied by the annuity factor. So 60 million in a year's time is worth $14,560,000. Okay. So at 31st December 2015, the finance cost will be the $14,560,000 deferred consideration times the 10%. Let's tackle the last aspect of the consideration, which is contingent consideration. So here, a parent may pay cash or transfer shares in the future based on the occurrence or non-occurrence of stipulated factors or events. Contingent consideration must be recorded on the date of acquisition at fair value, either as equity or liability. So it is to be recorded as an equity if it is expected to be settled in a fixed number of the acquirer's shares. There will be no further or subsequent adjustment to the fair value. In all other cases, recognition as financial liability is better. So if you don't recognize as an equity, then the other option is the liability. The contingent consideration recognized as a liability is potentially adjusted to its updated fair value, and its associated gains or losses is recognized in income in the statement of profit or loss. So a contingent consideration can result in an asset if the parent is to receive back a consideration already paid due to the subsidiary's failure to meet the stipulated conditions or events. Let's finally test our understanding. So Edco acquired Ryan Limited by issuing 100,000 of its common shares and a promise to pay 10,000 additional shares if Ryan Limited's average revenue for the next 3 years exceeds $20 million. The current stock price for Ed is $100, whilst that of Ryan is $50. There is a 50% chance of Ryan Limited meeting the earning targets. There are two types of consideration here. We have the share exchange and we have the contingent consideration. So for the share exchange, it will result in $10 million, which is the $100 fair value of the parent times the 100,000 shares they have already issued. When we come to the contingent consideration, it will lead to $500,000, which is the 10,000 shares the parent has promised to issue times the value of its share times the 50% probability of occurrence. So the present value of the consideration will be $375,657. They are going to issue the 500,000 in 3 years' time, but we have to discount it to the date of acquisition so that we record it. It will arrive at 500,000 times 0.7513, which is the annuity figure. So we find annuity by using the formula 1 divided by into brackets 1 plus r brackets close raised to the power n. So the r is the rate, which is 10% in this scenario, and the n is the number of years, which is 3. Then we record the same figure as equity because they promised to issue shares. Then total consideration will now be 10,375,657, which is the value for the shares issued above for 10 million plus the 375,657 for the contingent consideration issued. All too soon, we come to the end of this episode's lecture. I hope it went well. If you have any comment or feedback for us, do well to drop them in the comment section below. Whilst at that, kindly subscribe and turn on all notifications to stay abreast with our postings. Also, follow us on our various social media handles as captured on the screen. Join us on another episode of Tutorials on the Go. Until then, take care of yourself and stay blessed. Poker.